I'm assuming you get this inflation question roughly correct, transitory or permanent. That makes up half your strategy already. So what do you think? What do you think is happening right now with this inflation question?
Well, I think where we are right now is really a tussle between the interaction of inflation with the current amount of capacity, spare capacity that we have. So it's not that we've got the starting point wrong, which we know that cost push is coming through. The end point is complicated by the fact that we don't know what kind of multipliers and interactions go on. Our base case is that it is going to be largely transitory, but with a very uneven impact, because it's going to have an adverse effect on countries that are less able to deal with that cost push coming through, and hence hampering the demand recovery that's expected. Whereas I think other economies might do better.
And I guess the next question there would be then, the one country where perhaps that matters to most other countries would be the U.S. In what sense do you think this inflation question then, in the context of the Fed and what they might do in the next 24 months, do you think they'll need to move earlier?
I think, if we fall back on our usual reflexes of the Fed that we used to know, then the answer is quite clear. Yes, they will have to move much earlier, because not only do they have cost push coming through, but the unprecedented stimulus also means that growth is going to outperform any one of their peers, and even by historical standards, which means Taylor rules suggest they should move a lot earlier. But we are under the new paradigm of flexible average inflation targeting, so we don't know exactly how much inflation overshoot and for how long the Fed would tolerate. So our best guess is that it's not going to be a hold throughout 2023. You could get a rate hike as early as late 2022. But I think that the question that markets are really fretting about is what it means for taper in that case.
Absolutely. And I think this term premium chart that we have here back above zero, some have pointed to this as being essentially a strong signal that the markets have essentially maybe almost priced in taper. When you look, let's put two things together now. So let's look at a 10-year Treasury, 1.5% roughly, 1.6. You look at commodity prices, 10-year highs. They don't seem to be connecting. There seems to be a disconnect between the two. Do you think Treasuries are too expensive at this point?
I mean, it does look like it's very expensive, but then we've got a very deep-pocketed, investor, if you may, buying it. So the competition for treasuries is quite steep. So that's making it expensive, isn't it? And I think you hit the nail on the head. I mean, what we're dealing with is really a cackle of disconnect in the economy, whether it's commodities versus USTs or USTs versus the real economy, equity, asset markets, real economy, and that, I think, makes it very difficult for policymakers to be fair to them.
Let's talk about India. That's a big part of the global demand equation, of course, and there's a big debate going on right now, especially in the energy markets, whether or not oil at $70 is properly pricing in any impact in demand coming from India. The consensus forecast for this fiscal year in growth, 11%. I know you've brought yours down 6.8 to 7.8%. That range, Vishnu, is there downside or upside risk to that forecast?
I'll put it this way. I think in the next 6 to 9 months, the risk is a downside risk. And beyond that, it is a very clear and perhaps larger, upside outcome or likelihood, if you may. And I think that's really being driven by the fact that what's worrying is it appears that the strategy that India has taken is still one of really, pressing down hard on vaccinations, but forgetting that vaccination is a linear equation, whereas the outbreak is an exponential one. And I think that means that the recovery could be retarded a lot longer than it ought to be.
So does that mean a bigger budget in 10 months?
I think that was from the outset, we needed a bigger outlay. How that's going to be financed is the biggest question. But in terms of effectiveness, how that's going to be spent would really be what determines the initial stage recovery. And the big thing about this is fingers crossed that rating agencies are not too quick on the draw and give India that kind of space it needs to ride through these fiscal soft patches, rather than exacerbating the downside right now with the premature negative credit action.
Okay, I want to bring in China then. That's the other big part of the demand equation. And justifiably so, as you point out. You look at everything from earnings expectations, PMIs, trajectory of data, rate of change of data. China seems to be getting left out of this rebound. You make a very important nuance. What do we need to understand about the Chinese economy right now?
I think the thing about the Chinese economy is we need to be quite mindful of the fact that policymakers are not fretting the 6 months growth headline. Rather, what they are looking at is a much longer term strategy of the dual circulation, and that also means that we're going to get a recovery that's going to be very, very uneven. I mean, you're going to get the new economy where investments ought to be in chips, in high tech. Those things are still going to be doing well, while they're still going to struggle with keeping the frothy aspects of the property market in check, and really channeling credit flow appropriately without upping financial risk to the point of risking a Minsky moment. I think those will be the biggest challenges for China. But what China is dealing with is really a strategic positioning at this point of time, rather than the cyclical cheer that they want to showcase.
Vishnu, your call on the dollar. Final question.
Well, I think the dollar will probably be fairly soft this year, more volatile because of things like what we just saw overnight. Markets will be grappling with when the Fed will move, but the Fed will have the last say for now. Next year, I think as taper risks really come to the fore, we expect a sharp squeeze in the dollar. If it's accompanied by your 10-year, 2-year spreads going above 180 to 200 basis points, we might have that kind of a taper tantrum event. So those are the risks around the dollar.